You can see it, spend it, and even help pay for it, and still not control what happens next. A card can carry your name, cash can sit in an account you share, an employer contribution can appear in your retirement balance, you can help pay a mortgage. But 4 labels can change what that security means: authorized user, joint owner, unvested, and deed. When I say these things may not be yours, I mean not fully under your control. Not that you have no rights. Use 3 tests. What's my documented role? Who can act without me? What survives a job or relationship change? Start with the card. The first thing is the available credit on a card where you are an authorized user. An authorized user card can look and feel completely normal. Your name is printed on it. You can put it in your wallet, you can use it at the grocery store, book a hotel, or pay for an emergency repair. Depending on the issuer, the account may also appear on your credit reports. That access is real, but it is not the same as owning an independent credit account. The account holder can generally contact the card issuer and ask to remove an authorized user. The user does not have to approve that request. The card may stop working, even though it still has your name printed on it, and even though you used it responsibly for years. That does not mean becoming an authorized user is always a bad idea. It can be convenient for household spending. It can allow a family member to make purchases while one person manages the account. Depending on the issuer and credit reporting system, the account may also appear on and influence the authorized user's credit profile. But convenience is not independence. There is another clue in the contract. An authorized user is generally not responsible for repaying the debt in the same way as the account holder. That can be a protection. It also reveals the nature of the arrangement. The account holder and issuer retain the primary authority to administer the account. This is why the sentence, "I have a credit card," is not specific enough for a financial security audit. The better question is, what is my role on this account? If the answer is authorized user, then what you have is permission to use someone else's credit facility under the issuer's terms. You do not necessarily have a credit line that will follow you into a new household, survive the account holder's decision, or remain available after the underlying account closes. The credit reporting effect also needs careful language. Removal from an authorized user account does not produce one universal outcome across every issuer, credit bureau, and scoring model. The account may stop being reported, its influence may change, or positive history may remain for some period. So, the defensible point is not that your credit history will instantly vanish. The point is that you do not control whether that account continues to support your profile. Imagine 2 people with the same card in their wallets. One is the account holder. The other is an authorized user. At the register, the cards may work exactly the same. On the contract, they are not the same product. That is the ownership illusion. Identical access today can hide very different rights tomorrow. The corrective action is not panic. It is visibility. Pull your credit reports through annualcreditreport.com, the federally authorized source, and inspect how each revolving account describes your role. Look for language such as individual, joint, or authorized user. Then, ask whether you have at least one credit relationship that is genuinely yours to manage, subject to the issuer's normal terms, rather than dependent on another private person's account. For someone who is rebuilding or establishing credit, opening a new account is not automatically the right next move. Approval, fees, interest, spending habits, and the risk of debt all matter. The principle is narrower. Do not mistake borrowed account access for a complete credit foundation. The first item therefore fails our 3-question test as a standalone safety net. Your role is authorized user. Another person can generally end the permission, and continued availability depends on an account you do not control. Now, look at a number that can feel much more permanent, the total shown in your workplace retirement account. The second thing is the unvested portion of employer contributions. Here, one word changes the meaning of the entire dashboard: vested. Your own salary deferrals into a qualified retirement plan are always 100% vested. That is your money, along with the gains or losses attributable to it. Employer contributions can work differently. Depending on the type and terms of the plan, they may be vested immediately, after a cliff, or gradually over a schedule. So a dashboard might show a total balance of $60,000, while the vested balance is $52,000. Both numbers are useful, but they answer different questions. The total tells you what is currently credited to the account. The vested balance tells you how much of that account you have a non-forfeitable right to under the plan at that moment. Suppose, only as an illustration, that a traditional 401k plan uses a 3-year cliff for eligible employer contributions. An employee has contributed her own money and has $10,000 of employer contributions credited to her account. She leaves after completing only 2 years of service as the plan defines it. Her own contributions remain hers. But under a valid 0% before 3 years cliff, she may forfeit the unvested employer contribution portion. Notice what this example does not prove. It does not mean every plan uses a 3-year cliff. Some plans vest faster. Some eligible employer contributions are immediately vested. Safe harbor and simple arrangements have their own requirements. Service may be measured using definitions in the plan. The only reliable answer for a particular employee is in that plan's documents and records. It is also inaccurate to say that a forfeited balance simply becomes the employer's personal money again. Retirement plan assets and forfeitures are governed by plan terms and federal rules. Depending on those terms, forfeitures may be used for permitted plan purposes, allocated within the plan, or used to reduce future employer contributions. The participant can lose the right to the unvested amount without that amount literally turning into an unrestricted company checking account. That correction matters because accuracy is part of agency. We do not need to exaggerate the rule to understand the risk. An unvested employer contribution is conditional compensation. It may become fully yours if you satisfy the plan's vesting terms. Until then, it should not be treated exactly like cash in an individual savings account or like your own 100% vested contributions. This changes how you evaluate a job decision. Imagine comparing 2 employment offers. One has a higher visible match but a slower vesting schedule. Another has a smaller contribution that vests immediately. The match percentage alone does not tell you the value you are likely to keep. Expected tenure, plan terms, compensation, taxes, fees, investment options, and many other factors belong in the comparison. The same logic applies before leaving a job. Knowing your vesting date is useful. It is not an instruction to remain in an unhealthy or unsafe workplace for the sake of a benefit. It is information that lets you measure the trade-off instead of discovering it after the decision. The document to inspect is the summary plan description, along with the benefit statement or portal showing your vested balance. Find the schedule, find the plan's definition of a year of service, check whether different employer contributions vest differently. If the language is unclear, ask the plan administrator or benefits department for an explanation in writing. Then, update your personal balance sheet. Your own contributions and vested amounts can be classified differently from employer contributions that remain conditional. You are not pretending the unvested amount has no value. You are refusing to count a contingent benefit as though no condition exists. This second item fails as guaranteed security only to the extent that it is unvested. Your role is plan participant, the condition is continued service or another plan-defined event, and the amount available after departure is the vested balance, not automatically the largest number on the screen. The first 2 examples involved permission and conditions. The third involves something more subtle. 2 people may both have legal access, but neither person has exclusive control. The third thing is the full balance of a joint bank account treated as your personal emergency runway. A joint checking account is genuinely joint. It is not the same as being an authorized user on a credit card. Both named owners may have real contractual authority. In most circumstances, either owner can withdraw money, transfer funds, and sometimes close the account without obtaining the other owner's approval first. The exact powers depend on the account agreement and applicable state law. That makes joint accounts efficient. Rent or a mortgage can be paid from one place. Both people can see household cash flow. Shared goals become easier to manage. None of that is an illusion. The illusion begins when either person mentally assigns part or all of the visible balance as money that will definitely remain available to them alone in an emergency. The bank's authority to honor a withdrawal is not necessarily the final answer to who beneficially owns every dollar between the 2 account holders. State law, the source of the deposits, marital property rules, contracts, and court orders may matter. A person who withdraws funds may still face a later legal claim, but a later claim does not automatically restore today's liquidity. If a bank agreement allows either co-owner to move all available funds, the bank may process the transaction before a private dispute is resolved. That is the operational vulnerability. The issue is not that the other person unquestionably owns every dollar. The issue is that your ability to use the balance is shared with someone who may have authority to act independently. And this risk does not require a villain. A couple may communicate well for 20 years and still have an account affected by death, incapacity, a legal order, a bank restriction, a fraud review, or a sudden separation. A disagreement can also emerge between decent people under stress. Good intentions are valuable, but the bank operates through account agreements, verified instructions, and applicable law. This is why our money is emotionally meaningful but operationally incomplete. The phrase does not tell you who deposited what, who can withdraw what, whether both signatures are needed for any action, what happens at death, or whether the account can be closed by one owner. The right audit begins with the deposit agreement. Do not rely only on the name displayed in the app. Ask how the account is titled and what each owner can do independently. Can either owner transfer the full available balance? Can either owner close the account? What happens if the bank receives notice of a dispute or a court order? Does state law change the answer? Then separate two questions that households often combine. Question 1, what money are we choosing to manage jointly? Question 2, what minimum liquidity should each adult be able to access in their own name? There is no universal dollar amount. A useful target depends on expenses, income stability, dependence, insurance, health, location, and the household's broader resources. The structural principle is simply that shared liquidity and individual liquidity perform different jobs. An individual reserve does not have to be secret. In a healthy relationship, both people can know that each adult maintains a defined amount under individual control. Transparency and autonomy can coexist. In fact, a household can become more resilient when a problem with one person's card, account, identity, or access does not disable both people at once. This is not permission to drain a joint account, conceal marital property, violate a court order, or move money in anticipation of litigation. Those actions can create legal and safety consequences. Anyone facing an active separation, financial abuse, or a dispute over property needs advice appropriate to their state and circumstances. The general educational point is more modest. If your entire emergency plan is the visible balance in an account another person can also control, you do not have exclusive control over the plan. You may have ownership rights, you may have legal remedies. But the balance is not unilateral runway. The third item therefore produces a different result under our test. Your role may be full co-owner, not guest. Yet another owner may be able to act without your consent, and the amount available on day one of a dispute may be different from the amount a court eventually decides belongs to you. Now we reach the most legally variable item and the one most likely to be described inaccurately in casual financial advice: a home. The fourth thing is equity you assume you own solely because you help make the mortgage payments. Start with two documents that people often collapse into one. The mortgage, or deed of trust in some states, is part of the financing arrangement. It creates obligations related to the loan and gives the lender rights in the property as security for repayment. The deed is the document that transfers legal ownership and is recorded in public land records. Debt and title can overlap, but they are not identical. A person can be responsible for a mortgage without holding the ownership share they assume. A person can also hold title while another person is responsible for some or all of the loan. This is why the sentence, "I pay the mortgage, so I own half the house," is not a complete legal analysis. Payment is evidence that money was contributed. It does not by itself rewrite the recorded deed, but the opposite slogan, "If you are not on the deed, you own nothing," can also be wrong. Property rights vary widely by state. Marriage can change the analysis. Community property rules, equitable distribution laws, contracts, trusts, inheritance rules, and claims based on contributions may matter. Even the type of title used by two named owners changes their rights. That means this item has to be framed narrowly. If a home is titled only in a partner's name, and you are assuming that your monthly payments automatically create a recorded ownership percentage, that assumption may not be reflected in the deed. Your actual rights depend on your marital status, state law, written agreements, the source of funds, and other facts. The risk is often greater for an unmarried partner because there is no divorce process automatically available to divide the home. But unmarried does not produce one universal outcome either. A cohabitation agreement, another written contract, or state law claims may affect the result. Consider a simple illustration. Two partners live in a home titled only to one of them. The other pays a fixed share of the mortgage and renovation costs for several years. Inside the household, they describe the property as our house. That language expresses a relationship understanding. It does not tell us what the county land records show, whether there is a written agreement, how the payments were characterized, or what remedy state law might provide after a separation. If the relationship ends, the contributing partner may have a claim. She may also face a difficult, expensive process to prove it. A claim that must be established later is not equivalent to recorded ownership and immediate control today. The same distinction appears when someone is on the mortgage, but not the deed. Loan responsibility can damage a person's credit if payments are missed, while the ownership rights may not match the burden they carry. Being liable for debt is not proof of receiving the corresponding equity. The home audit, therefore, has 4 parts. First, locate the current recorded deed or reliable copy of the title documents. Identify every legal owner and the form of ownership. Second, inspect the mortgage documents separately. Identify every borrower and every person who pledged an interest in the property. Third, gather any written agreement describing down payments, monthly contributions, repairs, appreciation, sale proceeds, or what happens if one person leaves. Fourth, if the documents and the household understanding do not match, obtain advice from a real estate or family law attorney licensed in the relevant state before changing title, signing an agreement, transferring money, or making assumptions about a breakup or estate plan. Changing a deed is not a casual administrative fix. It can affect control, taxes, creditor exposure, inheritance, eligibility, refinancing, and the rights of both people. The correct action depends on the situation. The video can teach you which questions to ask. It cannot decide the answer for a specific household. This 4th item fails as guaranteed security when the ownership you are counting on exists only in conversation, not in a deed, enforceable agreement, or applicable law you have actually verified. At this point, the pattern is visible. The card may be in your wallet, but your role is authorized user. The retirement contribution may be on your dashboard, but part of it is not yet vested. The cash may be in an account bearing your name, but another owner may have equal operational control. The home may be described as ours, but the deed and state law determine whether that description is legally complete. These are not 4 reasons to reject credit cards, employer benefits, joint accounts, or shared homes. They are 4 reasons to stop using access as a synonym for security. There is a second reason these distinctions are easy to miss. Financial interfaces are designed to show activity and totals, not to teach legal relationships. A card app shows available credit because that is what helps you make a purchase. A retirement portal may emphasize total balance because that is the broadest picture of the account. A banking app shows the joint balance because both owners transact from the same pool. A home value estimate shows the value of an address without knowing what percentage, if any, you legally own. None of those displays is necessarily deceptive. They are simply answering operational questions. How much can be charged? What is credited to the plan? What is in the account? What might the property be worth? Your security audit asks a different question. What right do I personally have to this value, and under what conditions? To answer it, classify each resource into one of 4 practical categories. Category 1 is owned and currently accessible. An individual bank balance without a relevant restriction may fit here. So might the vested portion of your retirement plan, although retirement plan distribution rules and taxes mean that ownership does not make it emergency cash. Category 2 is owned but not readily accessible. Home equity held through a properly documented ownership interest is a common example. The value may be real, while converting it to spendable cash requires a sale, loan, agreement from another owner, or other process. Category 3 is conditional. Unvested employer contributions fit here. The value is credited to you, but your non-forfeitable right depends on satisfying the plan's terms. A conditional resource can be valuable. It simply needs a probability and a condition attached to it in your planning. Category 4 is permitted access. An authorized user card is the clearest example. You can use the facility, but the permission and account continue under someone else's authority and the issuer's agreement. A joint account can span categories. You may own part of the funds while also sharing operational control over the entire balance. That is precisely why forcing every resource into a simple mine or not mine label produces bad decisions. This classification also prevents a second mistake, assuming that ownership automatically means liquidity. A retirement balance can be vested and still subject to distribution restrictions, taxes, and possible penalties. Home equity can be documented and still take months to access. Security requires the right kind of resource for the job. Long-term wealth, emergency liquidity, credit capacity, and housing stability are related, but they are not interchangeable. Now we can turn the 3-question test into an own-name audit. Create a simple table with one row for every resource you count in your safety net. Include bank accounts, credit cards, retirement plans, property, insurance, and any other major household asset or benefit. In the first column, write the resource as it appears in daily life. Joint checking, travel card, 401k, home. In the second column, write your exact documented role. Individual owner, joint owner, authorized user, beneficiary, borrower, titled owner, plan participant, vested participant, or another term used by the contract. In the third column, write the condition attached to continued use. Employment, continued permission from an account holder, a vesting date, 2 signatures, survival, a court order, a particular account remaining open. In the fourth column, write who can act without your consent. This is not an accusation. It is a map of authority. In the fifth column, estimate only what would be available under the documented rules if the job or relationship changed today. Do not use the most optimistic number. Do not use the most frightening number. Use the amount supported by the document and mark anything uncertain for verification. In the final column, identify the smallest proportionate action that would close the gap. That might be checking a credit report, reading a summary plan description, obtaining the deposit agreement, locating the recorded deed, documenting a shared understanding, or consulting a qualified professional. The goal is not to put every asset in one person's name. That would not be realistic, fair, or desirable for many households. Shared ownership can be real ownership. Joint systems can be efficient. Employer benefits can be valuable. A home can appropriately belong to one partner. The goal is to know which kind of security you have. Some security is individual, cash, credit, and assets you can manage in your own name. Some is shared, resources 2 people own and control together. Some is conditional, benefits that become fully yours only after a plan requirement is met. Some is protective but indirect. Insurance, beneficiary rights, contractual promises, or legal claims that provide value only after a defined event and process. Problems begin when conditional security is counted as unconditional, shared control is counted as individual control, or permission is counted as ownership. This is where choice capital comes from. Choice capital is not secret money, and it is not a prediction that something bad will happen. It is the portion of your financial life that gives you the practical ability to make decisions without waiting for another private person to grant access. For one person, that may begin with a modest individual cash reserve. For another, it may mean establishing credit in her own name. For someone else, the most important step may be understanding a vesting schedule or correcting a mismatch between a household agreement and property documents. The amount and structure will differ. The principle does not. Resilience requires both resources and documented authority. In a healthy partnership, this can strengthen the household. 2 adults who understand their accounts, credit, benefits, and property documents are better able to respond when one person is unavailable. They can make shared decisions from clarity instead of discovering the rules during a crisis. Financial interdependence is not the opposite of independence. The strongest version of interdependence is chosen by people who each understand what they own, what they share, what remains conditional, and what they can do. Now return to the 4 things we started with. The card in your wallet may provide access without giving you an independent account. The retirement dashboard may combine money you already own with money you are still earning the right to keep. The joint balance may be yours and still be controlled by someone else at the same time. The home may be emotionally shared while the deed tells a more complicated legal story. The solution is not to separate everything. It is to stop asking one resource to perform a job it cannot reliably perform. Shared money can support shared goals. Conditional benefits can build long-term wealth. Home equity can create enormous value. Authorized user access can be useful. But emergency liquidity, individual credit capacity, documented ownership, and conditional benefits belong in different boxes. So do not ask only, how much does the app show? Ask, what is my role? Who else has authority? What condition could change this? What would remain available if that condition changed? The answer may confirm that your foundation is stronger than you thought. It may reveal one narrow gap, or it may show that much of what felt like ownership was actually access. Whatever the result, clarity is not betrayal. Reading the contract is not pessimism. Maintaining appropriate resources in your own name is not a rejection of partnership. It is how you make partnership a choice instead of a dependency you never measured. Security is not the largest number you can see. It is the portion of your financial life supported by rights you understand, conditions you have measured, and control that will still exist when circumstances change. That is the difference between being allowed to use wealth and having the documented power to make choices with it.